Hi, and welcome to Swissquote's Daily Market Talk. It's Friday, October 3rd. The US government remains closed. The US jobs data will not be released today. The US yields and the US dollar remain under pressure, but the AI rally continues full speed after OpenAI became the world's most valuable startup this week, and OpenAI is announcing major deals every other day with other big technology companies that are investors' darling. So what could go wrong? We will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So yesterday was yet another day. Investors swung between political shenanigans of the United States and AI hype. Mood was not necessarily great in the very early hours of trading across the Pacific Ocean over Donald Trump's threat to fire thousands of federal employees during the US government shutdown period. And the US government shutdown doesn't sound like it will end anytime soon, as Democrats there are pushing for the extension of Affordable Care Act subsidies that will expire in a few months from now. But Republicans do not want to move ahead with anything without having secured funding. Now, bets on Polymarket, for example, suggest that this government shutdown in the US could last between 10 to 29 days, and that would become the second longest shutdown of the US government shutdown history, a thing that you could actually barely guess by looking at the market's performance this week. Because yes, the US 10-year yield came down to flirt with the 4% mark on some safety inflows into the US Treasuries, and the US dollar remains offered into its 50-day moving average, but that could be due to the Fed expectations because the major US indices barely blinked this week. Look, the S&P 500 and Nasdaq 100 both hit fresh all-time high levels yesterday. They were boosted by OpenAI's secondary share sale this week that rocketed the valuation of this company to 500 billion US dollars. In fact, employees there were allowed to sell up to 10 billion US dollar of shares, and they only sold for 6.6 billion US dollar, meaning that a big chunk of these shareholders of employees prefer to hold on to their OpenAI shares rather than selling them at the current valuation. This means one thing, it means that they expect the company to grow bigger, which I think is totally understandable. As such, OpenAI becomes the world's most valuable startup, overtaking Elon Musk's SpaceX, and the company expects to make around 20 billion US dollars in recurring revenue by the end of this year. So it is basically valued at 25 times these sales. It is a high valuation, yes, but it is not shocking either when you think of the reach and the potential that the company has to grow, and compared to many technology startups that trade at much higher valuations than this. So OpenAI is a greatly valued company, but because you can't yet buy OpenAI on public exchanges, the news echo across the related sectors and companies. In this context, Microsoft and Nvidia, for example, are among these companies that do have exposure to OpenAI, along with SoftBank, for example. And Nvidia will also sell chips for their massive data center project to OpenAI. So, looking at these shares, appetite for Microsoft yesterday was soft, but Nvidia actually notched another record high, following a rally in Korean SK Hynix and Samsung as well yesterday on similar news about OpenAI that they will use their chips as well in their upcoming US data centers. In other news, AMD also jumped yesterday. It jumped 3.5% on news that they will team up with Intel. As such, Vanex Semiconductor ETF hit a fresh high as well yesterday. Happy days. Now, valuations are high. Some investors are wondering whether this is not another technology bubble, but a bubble, by definition, is not a bubble until it bursts, which leaves global investors with an unbearable FOMO feeling, so this fear of missing out a further rally in technology names, and keeps these valuations high and demand tight. Now, prospects of multiple rate cuts from the Fed also help support these valuations mind you, and that rhetoric remains in place for now. So speaking of that, the Federal Reserve is expected to announce 2 more interest rate cuts before this year ends. That I think is, well, I think that's understood by everyone, but the Fed needs data to confirm that the US economy needs these rate cuts. And the data that will determine whether the US economy needs 2 more rate cuts this year is the jobs data, because this is where the weakness in the US market is the most apparent, as growth has been 3.8% last quarter, remember, and the inflation metric that's closely watched by the Fed is trending near the 3% level, which is well below the 2% policy target. So the jobs will determine whether the US needs rate cuts or not. So it's a bit of shame that the BLS won't be able to release its latest jobs report today because the US government is closed. Happily, and I say happily in an ironic tone, mind you, the privately owned data provider ADP reported on Wednesday this week 32,000 job losses last month, and that actually helped keeping the Fed doves in charge of the market despite the lack of official jobs data. But yesterday's challenger job cuts was down by 25% as well, giving mixed signals about the US jobs market and its health. So the ADP euphoria is now fading, and official data from the US government would be really good to help keeping these Fed doves in charge of the market and tell investors whether the US really needs those 2 rate cuts before this year ends. And because we don't have the government data, well, we will continue to watch data from private data providers and try to shed some light on the US fundamentals as much as we obviously can. So in this context, the ISM's non-manufacturing data will be in focus before the weekly closing bell. So the thinking is always the same. It will not replace the good old jobs data, but a softer than expected set of data from ISM today could give a hand to Fed doves, keep the US yields and the US dollar under pressure and equities supported. While a set of stronger than expected ISM figures today could give some support to US yields and the US dollar and weigh on equities eventually. But the perception of good news from the markets and investors today will likely be reflected much weaker than in case of bad news, given the overall market tilt toward Fed dovishness and not the contrary. Now, in the FX space, the US dollar may have spent this week under pressure, but the euro dollar will likely end this week without having successfully cleared the resistance near the 118 psychological level, meaning that the US shutdown story and the dovish Fed expectations of the moment are probably fully priced in, and there needs to be a fresh and new catalyst for the euro dollar to reach out to that 120 psychological mark. Same is true for sterling, mind you. Cable is back below the 135 psychological level right now, and the pair remains unappetizing due to the budget pressures in the UK. Note that the UK's 10-year gilt yield is not only near Liz Truss' mini budget crisis levels, but it is also diverging undesirably higher from the US 10-year yield. So that is definitely a drag for a further sterling rally, mind you, as the higher yields, the higher borrowing costs for the UK government, the narrower the UK government's fiscal headroom, and the narrower the government's fiscal headroom, the higher the chance of further tax rises and or spending cuts from the government, and the lower the growth expectations. So sterling remains under pressure due to all that, and it's not going to disappear overnight. Elsewhere in commodities, gold consolidates near its all-time high levels this morning, while US crude broke below the $62 per barrel psychological support, breaking actually a solid support since August on the narrative of more supply from OPEC in the coming months. Now, looking at the technicals, trend and momentum indicators here remain comfortably bearish, and the RSI index is not yet flashing oversold conditions. So that means that the bears, the oil bears, will be tempted to test the $60 per barrel level in the coming days. But I still believe that we will see a solid support there. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a lovely weekend.